Hello traders, welcome to a quick video I just want to put together. It's the 4th of January, it's the start of a new trading year for myself, and after taking a few weeks off and looking to get back into the markets, I generally sit down, I review what happened last year and towards the end of the year and look at what we have coming up for 2016, so I'm aware of all the fundamental aspects, and then I move into the technicals, and then I'll move down into some intraday stuff to try and get myself back into the swing of things, catch up with what the market's up to, and basically try to get back into the rhythm. And this is something that I haven't really seen too many people explain in the past or go through. So I've already gone through it today, but I thought what I should do is probably just recap and do it on a video, and perhaps some of you might get some sort of benefit from it. So I'll go over, basically I've got a pad and I've written down all the things that happened, and then I look through into 2016. So I'm just going to go exactly through what I've written in the diary, that my new diary for 2016 and for trading, and that's how I'm going to kickstart things. So 2015, the yen was the best performing currency in the G10s, and US stocks climbed to a new high. The US dollar remained strong along with the yen, and what all of this tells us that 2015 was haunted by a series of events. It was indecision, because all of those aspects are the safe havens, and that's where the money flowed to. On the back of the market was haunted from the Greece crisis, the Paris attacks, the geopolitical risks, and everything that's been going on with ISIS, the great migration through Europe of people. We've seen the war on oil with OPEC and the rest of the world. We've seen China basically continuing to reduce its growth and not meeting targets, and we've seen commodities collapse. So they were the key events that happened in 2015, and 2016 moving into that, it's those same events that we need to continue to focus on. Like the US, the Japanese economy was on the mend and the road to recovery, so it's something to keep an eye on. It was a very terrible year for commodity currencies, for the Australian dollar and New Zealand both losing 10% to the US dollar. That was thanks to China and the commodity collapse. But also we've seen the Canadian dollar really come under pressure as it was haunted by oil. That was a key story towards the end of the year, as was the Fed raising rates. And we got that 0.25% interest rate hike, and the markets didn't panic or anything like that. But now the next move is probably more important than the first move. All year we had to play that emotional, psychological roller coaster that was brought about just because of the Fed and the way they handle the situation of, yes, they're going to raise, no, they're not, yes, they are, no, they're not. And you can see that in the US dollar index, which we'll have a bit of a look at, and you can see it in the price action very clearly. Now, the next move is going to be, when are they going to raise again? And all bets are towards March. And that will set the trajectory for, basically you've got 2 points of an interest rate rise, and you can draw a line, and that's going to set the benchmark for the market's expectations for the trajectory of future growth, and therefore future interest rate hikes from the US, and that'll be reflected in the US dollar throughout 2016. So we need to keep an eye on that. So they're the key things for 2015, but this video is more about getting us up to speed, what we need to look at for 2016. So I'll go through what I've written down here as the key things to basically go through, and then I'll move into some charts. But the Japanese officials downplayed the requirement for further stimulus. However, the market is unsure at this point, so the data is going to be closely watched as to whether the Japanese economy will actually start to grow, and we will see some sort of signs that we don't need to see further stimulus from the Bank of Japan, as they have been suggesting. However, if China doesn't get their growth under control and stabilised, I think that the Japanese officials are going to have no choice but to do a little bit more stimulus. So keep an eye on China, that's a key theme, and both for risk on, risk off. You can even see today we've seen the yen strength extraordinary in the yen crosses, and that's because of Chinese manufacturing data came in even worse still at 48, which is well below the area of 50, so below 50 is in contractionary territory, so we're still falling and we're actually falling at a greater pace because we're at 49 last month. So right now the market is heavily focused on China there. I believe we could see a bottoming of the Japanese economy, and I don't expect the Bank of Japan to hit its current inflation target though. So we're probably going to be hovering around a bottom here. Now, I need to emphasise, because we've got a few economies that look like they're at this point. When we're getting towards extreme levels or bottom areas, it's not just a simple, there's the bottom and it's just going to bounce. We go through a period of choppiness, indecision. Is this the bottom? Isn't this the bottom? Price action can consolidate. We can have false breakouts both to the upside and the downside depending on some shorter term macro events or risks that have happened. So be aware of that. Don't expect that, yes, we've got a bottom, whether it be in oil, whether it be in the Japanese economy, whether it be in commodity prices in general, and then all of a sudden we're just going to move in the opposite direction and everything's going to be peachy. That's not really how the market works. So I don't want you to just get into your heads that there's going to be opportunities to buy at extreme levels and the thing's just going to go in your favour and move quite smoothly. So you're going to have to be quite patient, I think, in 2016, and we're going to see some choppiness. But I do hope that towards the second half of the year we may be able to establish some sort of trend. But we'll have to wait and see. So the yen could rally a little bit more. So we'll have to basically see there. Now, in terms of the US raising rates, I've talked about that. Now, if that destabilizes things, we could see some more risk off and the safe havens be bought up a little bit more. And we'll have to play out there. Now, the US dollar is going to be key for all the major currency pairs, and I don't need to remind any of you of that. So just keeping an eye on the interest rate area there for the US dollar strength, and whether it can get out of the consolidation that it's in since we did have those big moves. And I'll talk about that in the charts a bit more. The Swiss franc had a phenomenal year. We had that SMB debacle this time last year, and wiped out a lot of brokers and a lot of traders that were trying to play that. I don't think we're going to get a surprise, anything like that in 2016, but I do believe that the Swiss will continue to intervene to try and protect themselves against the euro continuing to slide, because the euro sliding is just a direct reflection of the fact that they've done more stimulus and they're looking to continue on to try and support their economy that just isn't coming to fruition. I'll talk about that a little bit more in a minute, but the Australian dollar and New Zealand dollar, they had a real bad year, down 10% compared to the US dollar. 2016 for these currency pairs is going to be all about the US dollar interest rates, China, and commodities. And the Australian dollar and New Zealand dollar are left up to the mercy of that. They're along for the ride. It's not something that they're going to particularly be able to fight. They're going to have to just adapt to those bigger headline stories and those much larger economies. So you need to follow those stories if you're going to pick up why the price action is moving the way it is. China is moving from a manufacturing economy to a consumption economy. And this doesn't happen overnight. As I was saying, when you're transitioning, whether it be from extreme levels or not, we're moving from a manufacturing to a consumption economy. That economy has a lot of adjusting to do, and it does take time. And it's very similar to the Australian economy. We're moving away from a mining expansion phase into, whatever the Australian government decides that will replace the major income stream that the mining boom did provide. But right now they haven't really suggested a plan. We're just trying to move on with things, and we haven't really got a major industry that they're creating reforms to try and really build and develop to take up the mining investment boom, whether it be into medical research or technology. We're just not seeing that from the Australian government. So they've got their own headwinds there in terms of the economy just transitioning and adjusting. So be aware of that. Now, with dairy prices for the New Zealand dollar, we could see a little bit of a bottoming in dairy prices. They had fallen by 35% throughout the year, but they have started to find some support towards the end of the year. The supply and demand figures for dairy is looking much better than it is for commodities at the moment. So New Zealand is somewhat in a better position than Australia in terms of exposure to China and the commodity cycle. So we could continue to see New Zealand outperform the Australian economy throughout 2016. So I'll have to keep an eye out there. It really just comes down to China for those economies. And I've spoken about Canadian dollar and oil. It was an extremely difficult year for the Canadian officials and oil. Everyone was extremely bearish, and they still are. We're still seeing calls of $25, $20, and even some saying much lower. As I mentioned in my blog post in December, oil prices may get into the 20s, and things can happen when we get into some panic scenarios. As we've seen last year, prices move hard and fast when the market really feeds upon itself for a short period of time, and then it can have a bit of a bounce, and that's that choppy phase that I'm talking about in terms of when we do get to extreme levels. So oil and the Canadian dollar highly correlated. You need to follow both stories if you're going to trade anything to do with the Canadian dollar in a trading pair. So keep an eye on that. And obviously the US dollar will play a role in terms of the US dollar versus the Canadian dollar, and if they raise rates sooner than the market expects and the rest of the global economies continue to struggle, well then the US dollar strength is going to continue to hinder oil and support the US dollar versus the CAD. So keep an eye on that. It's going to play a big role in terms of the short-term price action. Now, this is a very big year for the pound. The Great British Pound has a very big year. It's mainly going to be overshadowed by political as opposed to the economics aspects. The UK did very well in 2015. It grew at 2.1%, which matched the US. It will be the next economy to raise rates, but let the speculation begin as to when. And that's what it's going to be about for the pound, is speculation when they'll be raising rates. The key to that, as to when they're going to be raising rates, I think is going to be in wage growth. That's the only aspect that hasn't picked up. Similar to the US. Remember, the US spoke about wage growth and they didn't get it, they kept holding off. Same thing with the UK. So keep an eye on the wage growth figures. Now, the reason why political aspects is going to overshadow the economy is Brexit. This year, they will be deciding on whether Britain will be exiting the European Union. At the moment, it's a 50-50 split. So when the market's torn like this, basically you're going to get the to and fro, you're going to get the choppy markets, and until we start to see evidence one way or the other, you're not going to see a trending market in the pound, and that's reflected in the charts, which I'll get to as well. So whether they leave the EU or not, that's going to create huge economic uncertainty, especially if they do look to leave the European Union. Supporters of a Brexit say that the UK would be freed of the European Union's financial obligations and responsibilities, which is in the billions of dollars each year. However, this could come at a cost of trade, investment and jobs in the short term, while the UK economy would have to really adapt to the new structure. So it's not clear cut. But the proposals for the Brexit is going to be the key for what the market speculates throughout the year leading into actually the final decision. So as the structure of Brexit proposals become clearer and we start to see the market price in whether they do or don't believe we are going to see it, that's going to control the movement of the pound. So keep that in mind. And finally, I'll just quickly go over the euro. It's been 6 years since the European crisis kicked off, and we're still seeing them struggle to turn things around. The recent desperate attempts for showing for more stimulus is basically showing how entrenched this slowdown is and how poorly the European Union officials have handled the whole situation. Doesn't government officials realise that being slow and procrastinating to react and when they do, doing it in a very slow, measured, reactionary way only makes things take longer, and it ultimately costs more. And that's what they're seeing, they're experiencing. The whole thing's been dragged out and could have been prevented, but political aspects come into play, as it does with all these things. So it is what it is. And in 2016, we won't see a reduction in stimulus. I don't see all of a sudden the European situation rebounding and things getting quite exciting. So in the near term, we've got a recent stimulus. They're still going to be quite dovish about the situation. But yes, Europe will be somewhat helped in 2016 by a lower euro, low oil prices that have been in effect for a little while now. It had time to filter through the system, and we could start to see some benefits of that, and obviously all the stimulus as well. So we could actually start to see things, the bleeding to start to reside in terms of the European economy, but I'm not expecting it to shoot the lights out. But with all that, we still need to really keep an eye on the key focuses for 2016, which is going to be China, the US interest rates, the geopolitical risks, Brexit, and obviously the commodity situation. So that's what we need to really focus on. Now, having a look here at the charts, I've got the New Zealand dollar. I'll quickly go through the majors. I've got it on a weekly chart, and you can see the big falls that we've had here, and then we've had a bit of a bounce. Now, that bounce towards the end of the year is after what we've had, this free falling situation, and it could be a pullback before we continue to move lower in the throughout 2016. However, as you can see here, 70 cents is a major resistance level. A breakout up through here is only going to create a short squeeze and continue to push up into this area here, between 70 and 75. But we could continue to drift lower. As we move down through the charts, I'll be going to the daily, and you can see that we did form a bottom down here, and we have been moving higher, and we can see that we have rejected it at the 200-day moving average, the 70 cent, a bit of a double top forming here, but I wouldn't be getting extremely bearish and saying that this whole rising triangle wedge formation doesn't break out in either direction just yet. So continue to trade it within this pattern, and keep an eye on the US dollar and the risks. Obviously, it's being sold off, as I said today. I'll go to the 4-hourly chart. You can see heavily sold off today due to the Chinese manufacturing situation not providing much support for 2016 so far. So thin volumes, everybody's still ramping back up into 2016. So price action is going to be quite large in terms of the reactions. But nonetheless, we should start to see this reflected also in the Australian dollar. So this is the weekly for the Australian dollar. You can see that we've had those pretty big falls as well. But we've started to consolidate towards the end of 2015, moving into 2016. You can see this consolidation pattern right here is still in effect, and we just need to continue to really trade within this range. Don't expect any major breakouts, any major trends. You can see that we've got some higher lows and some lower highs being made, and that double top very similar both here and here to the New Zealand dollar. So a breakout above here could definitely push us up between where it's 74 cents up to sort of 78, and at the extremes 80 cents if we did get a breakout. But with Chinese situation, a breakout to the downside is probably more likely if we continue to see the unraveling of the market's expectations moving into 2016. The pound on the monthly chart, I haven't got any lines here. I've spoken about the Brexit. I've spoken about the serious situation of will they, won't they, and the just the political risks that are associated, and also whether they'll raise rates. Now, obviously, if the market starts anticipating they'll raise rates, we could start to see it move higher, but the Brexit situation is going to dominate all political and all economical situations and expectations. This is the daily. You can see that we have come off, and we didn't get off to a real good start in 2015. We did have a bounce, but then we faded away, and we have closed lower throughout the year. Now, 2016, we do have a lot of support areas down through here that we need to keep an eye on, and it could be just a real choppy year for the pound. As I mentioned, speculation as to whether they'll exit, whether they won't exit. That's really what the market's going to be trading. So I don't expect any major trends unless we do get the market starting to think that we are going to get a major Brexit, and that's going to create economic unrest, and uneasiness and uncertainty, and then we would get a breakdown at the pound, and it would be quite significant. And all these levels here would definitely be tested, and whether we made a new low or not, that would only be in a very extreme situation. So right now with the pound, it's quite a choppy market. Now the euro, on the other hand, it didn't have a good year. 2014 was a terrible year. 2015 we got off to a bad start. We did bounce and we consolidated through this period. Very choppy market, and then towards the end we got that stimulus and it fell, and then we've had a bit of a bounce and we've consolidated right here. So clearly we're making lower highs, and we've formed a bit of a base here. 105, 104 and a half. This support area, if broken to the downside, could see all those people calling for parity. Should definitely see it with the price action moving down here. So a breakout of these levels, I'm sure there's a lot of stop loss levels there that would get triggered, and the price action would quickly move to parity and would start to be getting into the 99-cent region, as a lot of major fund managers have been calling for. Now, whether it gets there or not, we are short-term traders, and we need to just keep an eye on the shorter-term view. I'll have a quick look at the US dollar versus Japanese yen, trending upwards, and then we really went nowhere. As you can see, we went nowhere in 2015. It was a case of they're going to raise rates to really, the market lost interest altogether in the Fed and the whole situation. And the US dollar long started profit taking, as you can see, throughout this period. And then we did actually lead into getting an interest rate rise. But then the US dollar sold off, especially because the yen strength, as I mentioned earlier, that's the safe haven. Everybody's running to the yen when we've got these problems. And right now you can see China's playing a big role in that. And we're going to continue to see the US dollar come under a little bit of pressure with the strength of the yen as we move forward into 2016, especially if we do see China continue to struggle and any other risks that I mentioned earlier come to fruition. US dollar versus the Canadian dollar has been one that has had, I'll go to the weekly, a phenomenal year. It's rallied quite significantly. It's had quite a big run. This is as oil's really fallen to the wayside. And we're getting some US dollar strength, as it is a safe haven, obviously not as much as the yen, and it is being bought up against especially the commodity currencies, and obviously the Canadian dollar is one against oil. And you can see here that we had a very big rally. We've had a bit of a consolidation throughout the Christmas period, which I've highlighted here, and it looks like we're getting a bit of a breakout now to the upside. And we just keep an eye on oil, and you can see here the oil prices. We did hit a low on the daily, and then towards the end of the year, moving into the Christmas period, we've seen some profit taking just on the oil shorts, and then now we're kick-starting the year off, and it's just starting to see some selling right now. So it's a bit early to make a call on whether we move forward there, but a breakout of the $1.40, there's going to be a lot of stop losses above that, and we could start to see it really push higher. And if I clear some objects here for you all, we can see on the longer term we are moving up into some resistance areas. We've got 140 that if it breaks through, then 142, and then there's not really a lot. We can find some historical levels, but these ones over here in the 90s are pretty weak, and it's going to be just left up to the mercy of the US raising rates and how far oil goes as to when we find a top here. As I mentioned in the blog, I do believe we will find a top, and I'll be selling into the rally should it continue. All right, so that's the majors anyway. I just wanted to bring up the speed. That's the process I go through. Now, that's the big stories of 2015 and what to look out for 2016. They're not things to trade. They're things to have in the back of your mind. They're the themes on a daily basis to monitor, to follow, to keep up to speed with throughout the social media. I'll be on Twitter again in 2016, just sharing my thoughts, and that's the best place to keep up to date with me on a regular basis. I'll still be adding articles to the blog, But following on Twitter, if you want to get some insight and you want to communicate with me, we can chat on occasion through Twitter on just what the markets are doing. I just retweet basically anything that I've read that I think's relevant, and obviously my thoughts as well. So keep an eye out there. I use that information, and then from here we can break down into some shorter term opportunities and trading. So we use that information, and then we move down. And today we've had this rally, and then we had a breakdown here due to how bad the Chinese data was. Where you could have traded the breakdown of this rising trend line here on a 4-hourly chart. Obviously, it would have looked a bit bigger on the 1-hourly. And we'll take profit in certain areas, but you definitely wouldn't want to be selling down in this area, because I've just spoken about the longer term situation, and we do have some support and potentially some choppiness to endure before we start a new major trend. But that's going to be left up to China. Just on that, one thing I did pick up for myself, we all got to learn lessons each year in trading, and that's to have a view on the longer term, but don't try to get emotionally attached to any particular thesis, whether it be the euro's going to parity. So that can lead you to psychologically be skewed towards always wanting to sell the euro, when in actual fact, if we're day traders, we're speculators, we need to be looking at what the markets are really focused on in the short term, and be profiting from that, than trying to get the big win or to get the big long trend, and trading with an open mind. The market is fickle; it changes its mind all the time, and you shouldn't be really become emotionally attached to any one trade. Is really what I'm coming from here. That's a lesson that I learned, and in 2016, it's going to be a case of monitoring these major themes and understanding why the market's moving, and then reverting to the proven strategies that make money, and just executing those when the opportunities arise and you have all your ducks in a row. And that's when really the highest probability is. And it's a situation of not trading more, but trading smartly. So it's not going to be about the volume or the number of trades and jumping on every opportunity, but really doing your homework and taking the best opportunities, and knowing when to sit out and watch. Especially leading into some of these big decisions like Brexit. You wouldn't be putting any trades on the night before the decision of Brexit in anticipation of a result, because let's face it, you'd just be gambling and just guessing. Nobody knows the outcome, and you shouldn't kid yourself that you know something that everybody doesn't. You're better off waiting for the result and then trading the market's reaction and momentum and the market psychology as towards the result. All right, well, that's it from me today. It's been long enough. I just want to put this video out there for you. Hopefully it's given you some insight on how I bring myself up to speed, kicking off a new year. And then from here, I will be following the markets each day and slowly dipping my toe back into the market. I start off with lower contract sizes and work my way back up into full swing of things. I don't just jump in, and you try to get back into the rhythm of the market and start to really get in touch with what the market's thinking and where it's going before I'm full steam ahead. I wish you all the best in 2016. I look forward to chatting to you. Don't be afraid to contact me via the blog at petearmstrong.org or Twitter or Facebook. I'm happy to chat to anybody about the markets. I wish you all the best in 2016, and hopefully we'll all chat soon.